Today we'll explain how dividends work in whole life insurance policies, and we'll begin by answering this question. What is the difference between my guaranteed interest rate and my total dividend interest rate? The total dividend interest rate includes the guaranteed rate in your whole life insurance policy. So for example, if you have a whole life insurance policy with a company that is paying a dividend rate, let's say it is 6.10%, for example, and your policy has a contractual guaranteed rate, which is the minimum floor, of 3%, what does that mean? Well, what it does not mean is that you get both, which would be nice, but that's not the case. What it means is that we have a surplus that's included, and that surplus is the difference between the total dividend rate and the guaranteed rate, which would be 3.10% in this example. Okay. Now, a confusing part about this is that when we look at a life insurance illustration, we'll see a column that says annual dividend. Common sense would tell me that the column that says annual dividend would include the dividend rate. However, that annual dividend column only represents the surplus rate. It does not include the guaranteed rate. And we're going to go through some illustrations and look at that just so we have some visuals as well. Let's move on to our second question. When do I receive my dividend? Your dividend will be paid to your policy either at the beginning of each policy year or at the end of each policy year. You can find out by asking your life insurance agent, calling the company, or just reviewing the illustration that you looked at when you saw that cash value just grow to a big old balance down the road. Let's take a look at two illustrations. We'll look at illustrations with Mass Mutual and Guardian, two of the four major mutual companies. And we'll begin with a Guardian illustration. So what we've got here, policy with Guardian. When we look at the different columns, here's all I want to focus on. End of year dividend. The first word is what? End. At the end of each policy year, with a Guardian policy, you would receive your annual dividend. In the first year, dividends typically are not paid. It's only zero. It's zero, meaning I only get the guaranteed interest rate. Now in the second year, I see this dividend of $1,085. So if I got this policy and the dividend rate stayed exactly the same as what it is right now, and I paid the exact same dollar amount, I would get this dividend at the end of the second policy year. So that's Guardian. Another example is Mass Mutual. So if we look at a Mass Mutual policy here, annual dividend, beg year. Beg is short for beginning, meaning I'm not begging for the dividend. I am, but I know it's going to be paid. So the dividend is paid at the beginning of the second year. In both illustrations, you may have noticed that dividends are not paid in the first year, which is very common. Some policies do pay a dividend in the first year. However, if that's the case, it's usually very small. Typically, I only receive the guaranteed interest rate during the first year. And what you can always look at to see if your policy is performing is when you look at the illustrations, and particularly the cash value performance, where it reads net cash value end year. That is telling me what my cash value should be at the end of that policy year if I fund it according to what is illustrated. The cash value column includes the total cash value at the end of each year after the guaranteed interest is applied to my policy and any dividends. To summarize this question, when do I receive dividends? It is at the beginning of each year or at the end of each year, depending on the life insurance company. Our third question, when does the insurance company update their dividend rate? Insurance companies update their dividend rate every year. However, you'll receive the updated dividend rate depending on your policy anniversary date. If we look at two companies, let's look at the two we just looked at. We've got Mass Mutual and then Guardian. If we look at their 2024 dividend interest rates, Mass Mutual was 6.1% and Guardian was 5.9%. Whereas for 2025, they both went up Mass Mutual increased to 6.4%, and Guardian increased to 6.1%. So the insurance company declares what their dividend will be every year, typically toward the end of each year. So for example, Mass Mutual and Guardian between November and December said our 2025 dividend interest rate will be the numbers that you see here. So we know typically 1 to 2 months in advance what an insurance company's dividend rate will be for the next year. Now, for you as a policyholder, what you want to be aware of is this. Let's assume you started a policy in June of 2020. It doesn't matter. So your policy anniversary date is June. The year 2024, I should put it this way, June 2024, you begin to receive the 2024 dividend rate. Let's pretend you had a policy with Mass Mutual. Okay, so you've got a 6.1% dividend rate. Now, when January 2025 hits, you do not get the updated dividend rate at that point in time. It's on your policy anniversary date, which would be June of when? 2025. At that point in time, you'd begin to receive then the 2025 dividend interest rate of 6.40%. And you can always ask your agent too, what dividend rate am I getting right now? Because what an agent can see on their agent portal is the dividend year that your policy is currently in. So it's not until you hit the policy anniversary date that you begin to receive the updated dividend rate that the company is paying for that year. All right, let's continue on. Our next question, what affects the dividend interest rate? So this depends on the life insurance company that you select. However, you will find that most life insurance companies, when they adjust dividend rates, they're all typically close to each other, within 100 to 150 basis points typically, meaning 1% to 1.5%, and they all tend to go up and down in terms of trends. So what's going to impact your dividend rate with your policy is where the life insurance company that you picked invests their money. Now you'll see all life insurance companies have a lot of money in bonds, although that has gradually decreased if we look at it compared to the 1980s, but they still have a ton of money in bonds, typically well north of 50% of their total portfolio. Now they are investing in other areas such as high-end commercial real estate. What's become very popular over the past decade is seeing insurance companies invest in other businesses and even outright acquire other companies. A couple examples of that could be Mass Mutual in 2016. They acquired a division of MetLife. They made a purchase for about $165 million. They invested in their retail sales division, which means they merged with their sales team all of MetLife's advisors. And what happened is MetLife got into some trouble back in 2016. Their ratings took a big hit with what they were doing with annuities and such. So people were panicking naturally, saying, I don't want to keep my money with MetLife. They're going down the tube. They weren't, but people panicked naturally. So Mass Mutual said, we'll give you $165 million. And then what happened is MetLife advisors who had the relationship with all of their clients now said, hey, we've got access to this Mass Mutual product or these Mass Mutual products. Here is a A-rated, massive company in terms of size that's also very, very attractive when you look at their life insurance and annuity products. So Mass Mutual has picked up a ton of business since. I remember a couple of years ago looking at the returns on that investment where it had exceeded more than $1 billion. So it's been working out quite well for them. Another example is sticking with Mass Mutual. They had acquired a large annuity company a few years ago. That was a several billion-dollar investment. So what they're doing is making investments that can help drive more revenue and more business, which generates more profit, and then it increases their dividend rate. What insurance companies are always looking for, though, with respect to their dividend rates is how do we continue to pay a healthy or attractive dividend rate without taking on risk? What you won't see an insurance company do is put a ton of money in the market or risky investments because they can't. To illustrate, think of it this way. What if you owned a life insurance policy? What is your first and foremost obligation? To pay out life insurance claims to people that have life insurance. And the life insurance dollar amount is always larger than their cash value. So when they pay premiums, you have to go out and invest that to earn a high return, really to satisfy those claims and a lot more. But you can't go and take on risk because if you lose money, it's not going to work out at all, is it? No. So you'll always see insurance companies be very safe in that respect when it comes to where they are positioning money. So what affects the dividend rate is the insurance company's investments. Where are they putting the money? Next question, do I still receive dividends when I take loans against my policy? The answer is yes. This will happen every single time with a whole life insurance policy. If the policy is non-direct or direct recognition, the dividend treatment might be a little bit different, but the answer to the question is yes. You will continue to receive dividends and interest when you take loans against your life insurance policy. And you'll continue to get dividends on your entire cash value. So what that means is if you had $100,000 in cash value, 100K, and the dividend rate was 6%, and you took a loan against that for $50,000, you would have loan interest due. Let's assume that the interest rate is 5%. However, you're still going to get dividends, call it that 6% rate, on the full $100,000. If it's a direct recognition policy, you're still going to get dividends, just the dividend rate applied to the loan portion is not going to be 6%. Could be higher or lower depending on the insurance company's methods with their direct recognition treatment. But short version, or short answer to that question is yes, you continue to receive dividends. Next question, where do I see my dividend? So you can see your dividend on your annual statement. Your insurance company will mail you or email you an annual statement every year, and you'll see exactly what the dividend was for that year. You can also see it on your online portal if you have an online account with the life insurance company that you have your policy with. And then lastly, you can also see it on an in-force illustration. This will give you a projection of what the dividend should be for the policy year you are currently in. Our next question, does the dividend show what my cash value is growing by? Meaning, if on your annual statement you see a dividend of $10,000, does that mean your policy grew by $10,000 that year? The answer is no, it does not. So let's take a look at an illustration for this. So what I want to hit on here is first the dividend column. So we had looked at this a little earlier. There's our year 2 dividend we looked at earlier. But look at age 50 with me at the bottom here. So age 50 is year 16. Why we're looking here is because at this point in time, what you're paying is 0. So any growth that we see in this policy is 100% coming from the life insurance company, meaning we're not adding money to keep on growing it. Make sense? So when we look at the dividend, here we go, $10,672. That's the dividend we received from the insurance company, and that's what we would receive from the company on our annual statement. We would see that if we're in this policy year. Look at this though. Here's your money column, net cash value. At year 15, your value is $399. The next year, you paid 0 in, and it's worth $420,000 in change. Is that more or less than the $10,000 dividend? It's more. It's about double, a little bit more than that, about $21,000. The dividend column does not represent the total growth in your policy. And the reason why, if we look at this specific example, this is Guardian. Their total dividend rate is 6.10%. The guaranteed rate with this particular product is 3%. So what that means is that that dividend column represents what is called the surplus, which is the difference between the guaranteed rate and then the advertised dividend interest rate. So it would be 3.1%, which makes sense in this example when we see that the dividend column represents about half of the growth. The dividend column does not represent the total growth you see in your whole life insurance policy. Next question is a percentage question. Does the dividend interest rate represent the net rate that my cash value is growing by? Another way to put it, if you see a 6% dividend interest rate, does that mean your money is going to grow by 6%? Because if you had money in the bank and the bank was paying you a 6% interest rate, it would grow by 6%. Not the case with a whole life insurance policy. So let's take a look at an example. We'll stay with that same policy, but we're going to look at this on Excel. What I want to hit on first is look at the year 15 cash value, $399, $655. So I just pull that up to let you know that what you're going to see here in Excel is the exact same policy. We just exported everything to Excel. At year 15, there's your cash value of $399. Now the dividend rate is 6.10%. Yet here is our net return. This is our annual yield. Simply, how much is my money growing by every year? The first year, it's negative 17.10%. Why? Because you paid in 20 and you have 16,580 to show for it, which means you have less than what you paid into the policy. That's why that net return is in the red. It's negative the second year as well, but then from that point forward, it's positive. However, it'll never hit that 6.10% dividend. The reason why is because a dividend rate is always a gross rate that is applied to our policy after the company assesses their insurance expenses and everything that comes with the actual life insurance policy. The net return shows the net after we account for those expenses. Now, not all companies will put this in their illustrations. Some will, but we can always throw it on Excel. We typically do this for all of our clients because it just makes it so much easier to understand when someone wants to know, how much did my money grow by last year? Like, I just want transparency there. That's how we can tell. Let's continue on, shall we? Next question is a good one. Does the policy design impact my dividend? The answer is yes. However, we want to be really careful with this. So talking about policy design, I'll start here. Let's pretend you're going to fund a policy with $10,000 per year. Okay. Of that $10,000, you, the policyholder, can actually decide where that money goes. It can go toward what is called the base premium or toward what is called your PUA rider. PUA stands for paid up additions rider. I like to call this a cash dump-in. And I like to refer to the base premium as the initial insurance expense. So if we're looking at cash value, what you'll find is that dollars you pay toward the premium do not build any cash value, especially in the first year. And the reason why is because the insurance company is going to overcharge us for the death benefit up front, which is the actual life insurance. So premium dollars buy us a big old death benefit, whereas PUA dollars, guess what? Show up in cash value. And we feel like this. Now we won't see all of the PUA payment show up in cash value on day one. It's typically somewhere between 90 and 95%. They do give you some life insurance, but it's very small compared to what the premium gives you. So when you see this, where do you want to put your money? The PUA rider. Everybody says that. How do I get as much cash value as possible? So back to our question. Does the policy design affect my dividend? Yes. What you'll see when it comes to dividends is that a life insurance company is going to pay you a higher dividend, which I'm also going to call the surplus, now that we've covered what the surplus represents. That's the dividend column on a life insurance illustration. You will see a much higher dividend on the base premium dollars compared to the PUA dollars. So what this means is dollars that you pay toward the premium, you don't get any cash value up front. So you're slow off of the finish line. However, the company is saying to you, if you give us more of your money up front, because you won't have access to it, but we will, we feel confident that we can go out into the marketplace and earn a high return with the money you give us, which as a trade, we should be able to then give you a higher dividend. Does that make sense? Here's my issue with it. It does not always result, or it rarely results, in you, the policyholder, actually having more cash value. A sales tactic we see a lot in the industry is go with a higher base premium because you get a higher dividend on the premium dollars, which means you should have more money long term. Where I have an issue with it is the policyholder is now taking a big hit up front and they're hoping that they'll have more money long term, but a lot of times it doesn't happen. And when we look at commissions in the life insurance industry, they are paid primarily on the base premium. So what can absolutely just trash a life insurance agent's reputation is if they go out there and sell policies with higher base premiums, leading people to believe they're going to have more money long term because I should get a higher dividend on it over the long haul. But then if the life insurance company plays games and still pays a lower dividend, which we've seen happen so many times, now the consumer lost out up front and they also lost out long term, whereas the agent won because they made the bulk of their money on that premium. So that's where I have an issue with it, where it can really just damage the agent's reputation and the reputation of the industry. Now, with that said, let's look at some data here. So we're going to look at 3 illustrations, all with the same company and all with the same product. This will be fun if you like numbers. What do we have first? Is a policy where you are paying exactly what we looked at earlier, $20,000 per year for 15 years. And here's your premium. So 100% of it goes toward the premium. Nothing is going toward PUAs. Here's your dividend column over here. Okay. So we're going to look at this on Excel, but if you recall, what the last dividend example was $1,085. We can see a much higher dividend here because we have a much higher premium than what we had up on the illustration previously. But the cash value is not that attractive, especially up front. It's about 0. Here's another illustration. Same product. So going back to the first one we looked at, 35-year-old male, preferred plus, that's the top health rating, whole life 95 product. Okay. Now, the next illustration is a design we see a lot in the infinite banking world. This is referred to as a 40-60 split, where 40% of his money goes toward the premium, and then 60% goes toward our paid-up additions rider. Okay. His out-of-pocket is exactly the same, $20K per year for 15 years. And we could go shorter or longer. We picked 15 years because that makes him 50 years old. Here's your dividend column. That's less than the example with the 100% base premium. Same product, same age, same health rating, everything's identical except for the design of the policy. But the dividend is different. And then this is what we've looked at thus far. Same age, same health rating, same product, different design. Now our premium is as low as we could set it. It's actually a little bit less than 10%. It's closer to 9%. But the out-of-pocket is the same $20K per year for 15 years. What do you notice about the dividend column, though? Less. So rather than go back and forth with the PDFs, I'm going to go through this on Excel. And what we'll start with is the 100% base premium policy. So here we have no dividends. This is just showing the raw values. Next, we've got the 40-60 split, meaning an $8,000 base premium, a $12,000 PUA, and there's no term rider attached to this policy. And then lastly, we've got the 10% minimum premium, and then the rest is going into PUAs. We do have a term rider attached to this policy. What is highlighted in yellow represents the break-even point, which is the first year your cash value is equal to or greater than your total payments. Now the next tab is going to show the same thing, but we're going to focus on the dividends. So here's your 100% premium. Your dividend in year 2 is $27.35. Next, we've got the 40-60. What's your dividend in year 2? $16.22. However, what's your cash value in year 2 compared to the first example? It's $10,000 more. So yes, I see a higher dividend with the 100% base premium option, but that does not mean that I will have more cash value. Let's look at the 10% design, where we are minimizing that base premium. Now what do you notice? The dividend is the lowest, but the cash value is the highest. And you can see that from start to finish. If we go down to age 60, you see the clear winner is the example on the far right, where we're almost at $700,000, which is so sweet because you've got the same product, same company, same individual paying the same dollar amount. Everything's the same except for the design. The dividend columns can be extremely confusing. Here's something that helps a lot of people: the actual growth, which is just showing what you are getting net from the insurance company every year. So for example, here's the 100% base premium policy. You pay $20,000. You have $700. That is a $19,300 loss. Ouch. That's a 100% base premium policy. However, the dividends will be the highest long term. So the argument here we often see is if you go with a higher base premium, you're going to have a higher dividend, which should give you more money long term. It is not guaranteed at all. The guaranteed values show the lowest cash values with a high base premium. So this is the 100% base premium. In purple is your actual growth. Then we've got the 40% premium, 60% PUA. This is so interesting. If we look at the bottom, because he's 60 years old, with the 100% base premium example, your dividend was $23,000. With the 40% base, lower base, means lower dividend. It's $20,000. But when you look at the total dollar amount you received from the insurance company that year, including the guarantees, which one gave you more? This one, by far. And that's the 40-60 design. If we look at the 1090, it's even more drastic, where the dividend is the lowest here. Again, looking at the bottom, your dividend is $18,000 and change. But focus just on the purple columns. Now what do you see? Well, the one on the far right by far has the most money, meaning your money grew by the most with this particular design. So this is where we've got to be careful when we're looking at the dividend columns. And if you just want the bottom line, so our last question is, well, what should I look at if it's not the dividends when I am getting a whole life insurance policy for cash value? The bottom line, which is simply, what is my cash value? If we compare these guys and look at the bottom line, here's the 100% base premium, here's the 40-60 design, and by age 60, even though you had a lower dividend every single year, you've got almost $100,000 more in cash value. If we take it another step and compare the 40-60 with the 1090, which is simply as low as we could go with that minimum premium, what do we see? A lower dividend all the way through, but you've got almost another $50,000 in the 1090 than the 40-60. Reducing that premium does reduce your dividend, but it gives you more cash value. So if the name of the game for you is getting a policy for cash value, I would always look at the cash value and avoid that trap of just looking at the dividend, as that is a tactic that is used to try to upsell higher base premiums. The thing is, the dividends are not guaranteed. And looking at history and actual results of policies, we see those minimum premiums deliver higher cash values to policyholders. So with that said, I do hope that this video was helpful. Please let us know your thoughts and any questions. Feel free to leave them in the comments below. You can also DM me on any of our social platforms. And as always, I hope this helps. Thanks so much.